are diving down a little bit, just taking a leg lower here as I speak, down 33.75 at 31.94, if I can read that correctly. Let me just cross-check that on some where it's written a little large on my screen. Um, Gold is up nope, it's up 1760 right now at 1716, 1717, and that is up about 1.1%. Bonds are stronger. 10 years up 21 ticks. The 30 years up 2 full points and 4 ticks. The dollar is mixed. The quote unquote safe haven currencies, so-called safe havens, are stronger. I always have to make this disclaimer, so-called, because obviously by regulation they're not safe, they are volatile, but they're considered safe havens because more often than not, they tend to be rising in a risk-off environment. That's the Swiss franc, that's up 74 basis points, and the yen up 59 basis points. And the euro is also up 42 basis points, has actually had a little lift higher here of late. The weaker currencies, the weakest one is the Australian dollar, down 90 basis points, the New Zealand dollar down 67 basis points. The Australian dollar had been rallying most of the week last week, and the yen had been weaker most of the week last week. The liquidity in the FX market is still not where it is supposed to be. That kind of these, obviously the prices are what they are, but the depth of them, for large traders, you don't get the prices execution that you necessarily want. That's at least what we see in the market. And so that may be partially explained why you have some bigger moves here once in a while. Crude oil, West Texas is down 32 basis points at 37.89, whereas Brent is down 34 basis points at 40.46. And yesterday the Brazilian real was very strong. Today it's rather weak, and that is down. I have lots of things here showing simultaneously, and so if I want to, I'm not going to read that off at the risk of reading it wrong to you. Alrighty, the equity markets around the world are obviously down as well. Not so much Asia, that closed way ahead of time. There, Hang Seng Index was up 1.1%. The CSI 300 in China was up 62 basis points, and the Nikkei was down 38, so that was weaker. In Europe, Eurostoxx is down 1.4%, the FTSE is down 1.7%, and the Swiss market is up just a tad. That could be related to pharmaceuticals. I don't have that quite here. Then on the bond markets, just let me see whether there's anything exciting to share with you on the world before I pivot over to other things. It's a bit of a mixed market. UK, France, Germany, bonds are stronger, but in Italy, Spain, Portugal, the bonds are weaker, so that's a widening of the spreads in the Eurozone. The Greek bonds are also weaker. Swiss bonds, incidentally, also weaker. Dutch ones are stronger. VIX index, we're at 2667. I've been mentioning some other fixed income metrics to you. The 3-month T-bill is 16 basis points. The 3-month LIBOR is at 31 basis points. Remember when I first started doing these things, we were way above 1% on the 3-month LIBOR, despite the 3-month T-bill being that low. Effective Fed funds rate at 7 basis points now, so that's been ticking up from 5 basis points. Nothing too special, but let me maybe stay here with the fixed income markets, with the Fed here for a moment. The Fed is meeting this week. A lot of talk about yield curve control. Well, what is yield curve control is that you pretty much put a cap on the yields, and that somehow is supposed to be a good idea. I think it's a horrible idea because caps are red lines. Red lines are there to be tested by the market. And people say, oh, the Fed has unlimited liquidity, has a bazooka. That is not exactly correct. That is what we want to be believed. But all fixed income instruments are linked somewhat. There are substitutes for treasuries. Now, obviously, by regulation, treasuries are the safest thing and whatnot. But I just mentioned, hey, there's a safe haven demand for the Swiss franc or this or that. There's a certain spread that these fixed income instruments trade with, and so they're like magnets. They're pulling one together. Now, clearly, the central banks are strong, but if you can't take one instrument, you might take a substitution instrument somewhere else. So if the Fed puts a red line in one instrument, then the money might be floating towards those substitutes, and that acts as a magnet on the on whatever the Fed is trying to control. And when you do forward guidance and QE, that's all fine because you still, well, fine, it might be an overstatement, but you're still giving the market an opportunity to express itself, and then the market may throw up its hands and like, well, so what? I mean, not worth fighting. But if you have a red line in the sand, hell, it's worth a fight, because I mean, just look at the Bank of England, where George Soros broke the Bank of England, and it's that sort of thing that will cause potential issues in the markets, and so why would they be concerned about yields going too high? The market would be pricing in a recovery, and is what is this now? We have to have the yields at zero throughout the yield curve in order to support any recovery until unemployment is at new record low levels. That's not a market. I mean, maybe somebody has seen that we haven't in the previous cycle. We were just okay printing an awful lot of money, so let's just double down and print even more money and see what's going to happen, and then let's see, make sure everybody gets a job. That is not how capital allocation works. You need to, for a sustainable long-term recovery, you need to allow market forces to play out. And I get it that in terms of crisis, that certain things might need to get done, but those are things that politicians should decide on. If central banks just have a magic wand to fix everything, well, you get what you see, and in this case, you get the rise of socialism, and you get all kinds of other things. What should stop any politicians from saying, "Hey, we're going to spend an unlimited of money to support my pet project"? If you can do it, because there's a magic wand and there's an unlimited supply of money. So those are conceptually wrong. In practice, that is also going to backfire at some point. And in the meantime, that sort of view is being ridiculed because just this morning, John Ferrer on Bloomberg TV made fun of Lisa Abramovich. Those of you who watch Bloomberg, they know they always they always teach each other a little bit. So it's not the end of the world. But but basically, John poo-pooed Lisa Abramovich for suggesting that the bond vigilantes might one day might be calling for higher rates. And so that's where we are, that the folks who are concerned about government spending, who are concerned about the bond market being able to support all of this, are just being ridiculed. To me, that is a clear sign that there is irrational exuberance somewhere, and it is a time to get concerned. Now, do I know the timing of when this concern is going to play out? No. Am I certain this concern is going to play out? No. But I don't like it, and I do think it is imprudent to just shrug it off. Anyway, with that out of the way, there's a guest on Bloomberg, an economist, suggested that there should be debt forgiveness. When you do get debt forgiveness, there's always somebody owning that debt, pension funds. And so he said, well, let's start with owing money to the government. Well, yes, that's called fiscal policy. And then, of course, that can happen. We've had some tax reforms, and you can change that. You can, obviously, as a politician, you can battle out on what you want to do. The challenge with debt forgiveness is on a broad scale is you're changing contractual terms. And that means that the odds of you changing contracts going forward are going to be higher. It will change incentives. It will change the way we act. Again, it's a very, very dangerous area to go down on. And something that's, in my view, far more helpful is the rule that was passed, the tax law change, in some European countries, you've had that all along, is that if you've had a loss this year, you can offset that with gains in the previous years, meaning you can claim back taxes you've already paid previous years. That's a subsidy that is done to businesses that have shown that they can be profitable. So it goes to the right sort of people. It is fiscal policy by all means, and it allows those companies to better manage that, and look at multi-year averages in how they manage their business. So that, in my view, is a very prudent way of going about those sort of things, and you don't need to kind of cancel that, so to speak. Also, you're encouraging people to take on that, and the ones who were prudent, you're whacking, saying, hey, you're a dummy for not having lived irresponsibly. So to me, that's a very very odd way of looking at it. And then I in, we, we have a morning briefing, of course, as most firms do. On that note, since I mentioned the firm, I want to make sure that I'm telling you that we're not giving investment advice here. And so the way I try to do that is by giving you this disclosure here just ever so briefly. I'm sure you have seen it by now that we're not giving specific investment advice. I said, I mentioned morning briefing, hey, we've postponed the downturn. I said, what do you mean? We've reached the low already. Of course, we've reached the low in absolute terms, but we have certainly not reached the low for everybody. Notably, I would think that many small businesses will suffer and suffer worse. Take the example of a restaurant that was barely breaking even or slightly positive, slightly profitable heading into COVID-19, of which there are thousands of around. So we go into this lockdown, they scream, they get the paycheck protection program, they manage to survive in this environment, and now restaurants are gradually starting to open up again. And as they open up again, the PPP program is going to run out, meaning no additional money is going to be made available. And now what, right? Restaurants are open, but the spacing between the tables will have to be larger. The capacity is going to be reduced. Not everybody's going to go back. And sure, hopefully, and quite likely, many restaurants will survive. But almost certainly there will be those that don't make it. Even in normal times, many restaurants don't make it. I would very much think, and obviously that's just an opinion, that an above average number of restaurants will not make it. And so similarly, other small businesses have a small shop, right? Actually, I talked to a employee in a small shop over the weekend, and she said that they've actually been very busy, busier than usual because people didn't want to be in the supermarket. They wanted to be in the small store because it's just less of a hassle, fewer people around, and less crowding and all that. And so they're probably going to be doing fine. And so all these little nuances that as being here, not an ivory tower academic, but sitting at my desk, might not be able to assess. Yes, the ingenuity of people and so forth will get many people to survive. But I would also think that there will be many that do not survive. If I just look at my pattern on Amazon here, I'm ordering things on Amazon that I would have picked up in the store before, and I've obviously had a trend to buy more things online. And that trend has only accelerated, and I'm not telling you anything you don't know. They've been busier than any holiday season, and it's not just been my gadgets that I've been buying. And then for a while, Amazon didn't have the stuff, so we went everywhere else. And then let's see, maybe the consumers will now be more diversified and buy things at other retailers. But I wouldn't be surprised if people are going to be veered back to Amazon because it's just easier to have one shop. On a somewhat related, and because I obviously like to support local business, I think 2 weekends ago, tried to look for certain automotive and electronic parts, and went to we have a local Fry's Electronics. That's kind of a super, like a big store with lots of electronic gadgets. Well, they did not have what I wanted, and similarly, the automotive shop didn't have what I wanted. And so I was driving around and trying to get the sort of things that I needed. And guess what? Next time I'll be even more tempted to click that button on Amazon rather than going to the local shop. The reason I'd gone to the store is because I needed those parts right then and there, and then obviously I didn't get it and I had to improvise. That's not the end of the world. But in any case, the point being here, the broader point being is that I do think that there will be, especially on the small business side, there's a delayed there's a delay in the bankruptcies that we will see, and similarly on the consumer delinquency side, a lot of if you look at the non-farm payroll report, for example, the from that you can read that the lenders haven't haven't foreclosed on commercial real estate. There is a certain percentage usually of that you see there, that you can read that from that report, and it's just that the courts may be open, but the lenders haven't been able to file the paperwork and whatnot. And so there's going to be a wave on that. Now, does that mean the markets are going to come crashing down because of that? I have no idea. I don't have a crystal ball. I do know we've gone very far very quickly, but I also think that people, especially with that latest non-farm payroll report, are maybe a little bit too rosy. Now, let's assume, for example, that all right, things weren't quite as rosy in that non-farm payroll report. The underlying healing is still taking place, and there's going to be plenty of space for anecdotes of things, how things are bad. But whether the market is going to perceive this as half full or half empty is of course almost impossible to discern. And so, what you do in this, again, we don't give specific investment advice. For anybody interested, we can take on very few separate accounts we can take on, and then coach people more directly. You can reach out to us, but more importantly, the important thing is that people have a process, because you shall be excused for being confused by what you see, and so. And it is not about beating the S&P 500. It is about meeting anybody's personal investment objectives, which obviously ought to be reasonable, and then maybe one needs to revise them if one's situation changes, health or income changes, and so forth. But one needs to make sure that one stays on a plan, and whatever that may be. And as I've said in the past, if you're a day trader, hey, be my guest. But don't become a day trader if you're somebody who's doing cost averaging, if that is your strategy. And if you periodically rebalance your portfolio, well, then you should continue to do that probably. And I have to say these things like probably, because again, I can't give specific investment advice. Anyway, the market continues to hover where it was as I started, and I shall leave it at that. Have a great day. Stay healthy out there, and talk to you soon. Take care. Bye-bye.